The best of Money Matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. China's equity market has been in the spotlight, trading at steep discounts, yet offering strong returns, particularly with the rise of sectors like artificial intelligence. The market is also known for its volatility, though, making it a space where active management and local expertise really matter. Against this backdrop, Fullerton Fund Management has launched the Fullerton Lux Funds, China Equities, in partnership with Cheng International Asset Management to capture long-term capital growth opportunities through a bottom-up fundamentals-driven approach. To help us understand the opportunities and challenges in China's evolving equity landscape, joining me now is Grace Yeo, Head of Investment at the CIO Office of Fullerton Fund Management. Grace, welcome to the show.
Hi, Hongbin. Thanks for having me on the show. And hello, everyone. It's a rainy afternoon. Do drive safe.
Thank you so much, Grace. Thank you so much for joining us. Well, Grace, just to start off here, China's equities are trading at steep discounts, but also showing strong returns, especially with the AI boom. So set the stage for us here. What is the current macro backdrop for Chinese equities, and why is it compelling now?
Well, we see major changes in the macro backdrop, supporting our positive view on China equities. Firstly, the policy backdrop is shifting. Now, China rolled out its largest stimulus since COVID last year, with fiscal support targeting key areas such as infrastructure, housing, and healthcare. This really reflects a whatever it takes moment to stabilize growth. The 6 trillion RMB fiscal package is about 4.5% of GDP, and half of this amount has already been spent. There is another 6 trillion waiting in the wings, and that could be front-loaded next year. The People's Bank of China is also helping to boost liquidity with various tools to encourage more bank lending and increase domestic demand. And we see the government acknowledging the significance of the private sector in the growth and health of the economy. In fact, major laws were enacted in May this year to encourage greater market access and improve regulatory clarity. Secondly, we also see structural drivers supporting Chinese equities. This includes a greater role in global trade, as well as sustained productivity and innovation, driving Chinese companies' long-term competitiveness. Now, China remains the anchor of RCEP, the Regional Comprehensive Economic Partnership. This is the world's largest free trade bloc, covering about 30% of the world's GDP, trade, and production. And China is definitely reinforcing its role in global trade, even as we see protectionism rise. We have also seen China's industrial upgrading initiatives emphasizing higher value products to improve automation, technological advancements, and AI. And of course, innovation is a major pillar of this structural change. Our analysis shows that the government and the private sector combined have invested a total of US $700 billion in real R&D. That's on par with the US. So you're right. I think investors are seeing the positive signs and buying into this story of stimulus, reforms, and growth.
Thank you for laying out what's, really there here. But how do valuations in China compare with global markets today?
I'm glad you asked. Now, China A market is actually trading only around 13 times on forward expected earnings growth of high single digits. This is cheaper compared to the US at 20 times and Japan at 15 times, even though both regions are actually delivering similar earnings growth. And historically, the Chinese market had traded in high teens. So while we have seen a re-rating in China, the market is definitely not overvalued at this stage.
Okay. So Grace, where do you see the most exciting opportunities for growth in China's equity market right now?
Well, we see lots of this. Maybe I'll just start with the Chinese brands. Right. These were traditionally recognized as producers of low-cost imitations, but really Chinese brands have undergone a remarkable transformation. Today, they are gaining significant traction among consumers around the world for their innovation, quality, and original design. Right. Singaporeans are driving Chinese electric vehicles, drinking Chinese bubble tea, and buying Labubus. In China as well, the top-down efforts such as the consumption trading program has also spurred demand upgrades for home appliances. But I think what's interesting is that consumers are actually making intentional choices on how they spend money. I was at a conference last week And the CEO of a travel company mentioned that it took only 17 seconds to sell a 80 days around the world travel package. Wow. And meanwhile, one of the hottest EV brands has a long waiting list of more than 30 weeks. So consumption is definitely an area of opportunity. Now, investors are also probably familiar with China's innovation story, but this really goes beyond the internet e-commerce companies. We also see new champions emerging in advanced manufacturing, robotics, and green energy. In fact, many of the world's leading companies in areas like solar panels, glass, batteries are Chinese companies. And these companies are driving China's next wave of growth. And China continues to deepen its partnership across Asia and Europe.
Okay, so how do themes like AI, consumption upgrades, or, green transition play into all of this?
Well, I think with a universe of about 5,000 overstocks, there's plenty to choose from, right? And for our fund, we're only looking at 30 to 50 names. So definitely we are looking for the best companies, and through rigorous research, we are uncovering some of these opportunities.
So let's talk about that fund. Against this backdrop, Fullerton Fund Management has launched Fullerton Lux Fund's China Equities. And this is, of course, in partnership with Cheng International Asset Management to capture long-term capital growth opportunities in China's equity market. So what exactly is this fund, and how does the fund position itself to capture all of these opportunities, Grace?
Okay, maybe let me start by explaining why active management matters in China. I think a lot of people tend to think of the Chinese stock market as very complex and idiosyncratic. And that's largely because the market is often rotational and momentum-driven, influenced in no small part by policy shifts, sentiment swings, and the dominance of retail investors. So a pure macro or top-down approach really risks frequent repositioning, high trading costs, and probably being caught off guard by sudden policy changes. So our approach is really bottom-up. We are looking to find remarkable companies through research and understanding their long-term intrinsic value. Okay, that sounds like a mouthful. What does that mean, right? It's really about finding companies based on their competitive moat, the ability to compound earnings, and generate strong cash flows with sound governance structures. So we're looking to incorporate the what to invest with how to invest, considering the fair valuation of stocks and investing with a margin of safety. So in other words, the Fullerton Lux China Fund takes a contrarian, long-term approach, and the discipline of managing a high-conviction, low-turnover portfolio has resulted in effective drawdown management and resilience over market cycles.
Sounds very interesting. But what makes this fund different from other China-focused products out there?
Well, Hongbin, as you mentioned earlier, we have partnered with Cheng International. Many of our audience may not be familiar with who this company is. Cheng International is a leading Chinese fund house and a subsidiary of Cheng Fund Management in China. They are one of the first 老十家, the first 10 managers approved by the CSRC. Now, this strategic partnership brings together Fullerton's international distribution network and Cheng's China investment expertise to benefit our investors. In fact, the Cheng Gaoxing Fund has won numerous awards, including the prestigious Golden Bull. I think you're going to ask me, what is this Golden Bull? Okay, this is like winning the Oscars in the asset management industry. Yeah, so we are partnering with them to find opportunities for investors, investing in a portfolio of 30 to 50 names to capture the long-term growth opportunities in China. And our fund is accessible to retail, accredited, and institutional investors.
Grace, Chinese equities, they're known for their volatility with sharp daily swings here. So how does the fund manage these risks while, still aiming for long-term returns?
Well, we are really following a very disciplined, research-driven approach, balancing growth opportunities with the prudent risk management. So maybe you might ask me, how do you find these type of companies? We are actually prioritizing 3 key characteristics. 1, competitive moat. So we're looking for companies with scale and cost advantage, deep client stickiness, and technology leadership, for example. 2, steady compounders. We're looking for the ability to generate recurring revenue growth, healthy cash flows, and of course, continuing to see clear growth engines to sustain this growth. And lastly, sound governance. We are understanding how the company exercise their capital discipline, where are they investing, where they're spending their money, and their commitment to shareholders. So really by identifying the right companies through this research and then being very disciplined in our portfolio construction, we just keep our eyes on generating the long-term results while navigating the market's short-term volatility.
Okay. Does the bottom-up fundamentals-driven approach help cushion some of this volatility as well?
Yes, definitely. Because I think when you find these companies and assemble the right mix, we have seen that in periods of market volatility, these companies tend to hold up better. But over the long-term cycle, because they're doing the right things, they still deliver earnings and we deliver returns for our investors.
All right. You've also highlighted the fund's focus on A shares as well. Why are A shares an important part of the China story today?
Well, A shares really represent domestic China, China's growth, with exposure to sectors like consumer, healthcare, and advanced manufacturing. These type of names are not always available in the offshore markets. And also historically, we've seen that A shares have shown lower correlation with global equities, providing diversification benefits for international investors. A 5-year correlation between A shares and MSCI World is only 0.2%. And also if you look at foreign ownership, the statistics paint somewhat similar story. As a percentage of total and free market cap, Chinese A share foreign ownership is about 8%. This is the lowest level since 2019. So definitely with 5,000 listed companies and a combined market value of 11 trillion, this space offers significant depth and access to meaningful growth opportunities, which is what we are trying to capture.
So for global investors, how can adding China equities, especially via this fund, improve portfolio diversification?
Well, I've mentioned just now about the low correlation and also the different drivers. I suppose there's a lot of interest in the US Magnificent Seven, the technology names. China also has a share of technology names, but other than the technology sector, there are other areas like green energy, consumer, so lots to play for. So definitely by having a different mix of names, we are quite confident that it will lower the correlation of an international portfolio.
Are China equities still relatively uncorrelated to global markets here, Grace?
Yes, I believe, of course, the recent run-up suggests that the correlation has increased a little bit, but if you look over the long term, it is definitely still somewhat lowly correlated.
All right. Well, before we let you go here, over the next couple of years, where do you see China's equity market headed?
Well, we are positive on China's equity markets. We see the market supported by policy stimulus, structural reforms, and innovation. And of course, the rise in liquidity alongside the regulatory reforms aimed at stabilizing and supporting key industries has also injected renewed confidence into the capital markets. We think this will continue boosting returns over time. So really for investors, the opportunity is real, but requires selectivity. And in this case, active management and local expertise are key. Fullerton would like to help our investors participate in this upside while managing the uncertainties.
All right, some great insights from you there. Thank you so much, Grace, for joining me today.
Look forward to speaking with you again, Hongbin, and have a good evening.
Thank you. You too. That was Grace Yeo, Head of Investment of CIO Office of the Fullerton Fund Management. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.